All right, I almost want to sing this next line, but here we go again, right? It's like on the road again. Oil prices were driven higher on Tuesday by this Iran-Israel conflict. Obviously, everybody sees that happening. Though a major oil and gas infrastructure and flows have so far been spared from substantial impact, which really has oil investors on pins and needles. While there was no noticeable interruption to flows, Iran partially suspended gas production at the South Pars field that it shares with Qatar after an Israel strike that started a fire there on Saturday. Now, Israel also hit the Sharon oil depot in Iran as well. And senior oil executives are really more worried about infrastructure in the short term rather than current supply. And here's the quote: "The market is largely worried about disruption through the Straits of Hormuz, but the risk of that is still very low," said Saxo Bank analyst Ole Hansen. Despite the potential for disruption, there are signs oil supplies remain ample amid expectations of lower demand. Now, my next guest, he's a markets guy. Please welcome to the show, Mr. Luke Lloyd. He's in Covington, Kentucky with the Lloyd Financial Group, LFG. Thanks for being on the show, Luke. All right.
LFG.
LFG. We all know what that means. All right. What are your thoughts here? I mean, it's been winging around like a yo-yo. Where are we going to end up? What side of 70? Are we closer to 80 or 60? What say you?
I think we're actually closer to probably 90 because I do think things are going to heat up a little bit more. They're not just going to escalate very quickly. And the reason I say that is everyone is missing the bigger picture here. Everyone's talking about the Strait of Hormuz. I think it's how you pronounce it. Everyone's talking about oil prices rising, causing inflation, but everyone's missing the actual big picture here. It's what's going on between the United States and China, because Iran tensions and Middle East tensions change the whole picture. And the reason is if you look at Iran exports of oil, China buys 80% of their 80% of Iran's oil.
Yes.
And that number in China's terms, all of China's imports of oil is 20%. So Iran's exporting 80% of their oil to China. China's buying 20% of their oil from Iran. So if the United States gets involved here and escalates things, you saw kind of news headlines yesterday that you're seeing aircraft carriers go over. You're seeing aircraft go over the Middle East. As that continues to escalate, it's going to hurt the negotiations that's rallied the market 20% the past couple of months of the good news of the negotiations. It's going to ruin some of those negotiations, and that's my biggest concern when it comes to the stock market.
Yeah, you're right. And, there's a bigger, I think you're alluding to it, but I was on another network earlier this morning. It was Fox. Everybody knows I'm on Fox too. But they asked me about World War III. And, until it's the U.S. against China overtly, I don't think we're there yet. But man, we better tread lightly because we're getting close to having that be the case. Everybody's standing behind another partner. So it doesn't look like that's the issue, but we have to be careful about that. Arguably, you can look at a lot of research that says that maybe World War III has already started because it's not going to be conventional. It's going to be more, cyber
economical.
Yes, and so you can read some research about that, but. You're exactly right. If all this goodwill, even if it is goodwill, I don't know with China, but all the work we put in so far could be ruined quickly because of the oil that goes back and forth between Iran and China. So it'll be interesting to see because right now everybody's trying to play it cool. A lot of these oil executives have come on saying we're good, we're well supplied in the short term. We just don't want to see any disruptions to the infrastructure. I don't know how that is not the case because I think that there's a high likelihood that happens.
Yeah, and there's the geopolitical tensions worldwide. I mean, it's not just the United States that we're talking about. Of course, we focus on the United States because that's where we're born, that's where we live. We're United States citizens. But again, I talk about this a lot. We as U.S. citizens sometimes get arrogant in the fact that we only talk about the United States. That's why, for my clients, from a positioning standpoint, I'm looking international at other countries as the whole world essentially. I think moves their supply chain away from China. Besides maybe Russia, and China might be kind of close, but there's other countries in Europe, Asia, South, America, Africa, all these other countries, I think, kind of had the same mindset that they're moving some of their supply chains away from China and moving them elsewhere. That's why we're looking at places that, besides what I talk about usually, the Mexicos of the world, the Indias of the world, maybe even the Argentinas of the world becoming more capitalistic. I'm even looking in areas like South Africa, maybe South Korea, these kind of places that are kind of close to the supply chains of all these different countries that could be benefiting from the supply chain moving out. So this is why we talk about the weakening U.S. dollar. If we have weakening inflation outside of the oil prices, if interest rates come down, the U.S. dollar actually weakens as well. So as U.S. dollar weakens as well, that could actually help those international countries. So I think from an asset allocation standpoint, there's nothing wrong with having a pretty heavy weighting in international stocks right now.
You're right, and that's more or less, I think a large part of that's a dollar story, which you just touched on. What's going to make this better? I mean, I'd like to think that we could get some trade deals, but you know what, Luke? I'm sorry to say this. I'm a conservative. I'm a supporter of the Conservative Party, but the checks in the mail is getting a little bit long in the tooth to me, if you ask. I mean, we need to see some rubber hit the road with some of these trade deals, don't we?
Yeah, I mean, it's all been talk and no game. I mean, you can talk big game, but it's not about action. I mean, that's what we're told our entire life. And at the end of the day, there's so much still things that need to happen, which is another reason that truly surprises me. I mean, working in this industry, it surprises you day in and day out. It's like things you expect to happen don't happen. Some things you don't expect to happen. But that's the name of the game. You can't get everything right 100% of the time. But what I have been surprised about the most is the fact that we have completely recovered from that sell-off we just saw back in March and April of this year. I mean, the fact that we've rallied back to all-time highs essentially on no deals. We've rallied high on negotiations. So this is where, personally for me, my clients, I've been de-risking portfolios. I've been onboarding some new clients, some with some legacy positions, some with capital gains, and we're willing to take some capital gains off the table just to kind of de-risk and de-hedge the portfolios at this point in time, because I don't see too much upside. I mean, I know the Mike Lees of the world who comes on your show a lot. Me and him just did a little mini segment today on our social medias. I mean, he's still all in with AI. I think AI is a great story and all, but at the end of the day, if the weakening economy hits, you also have some issues at the top that trickles down, and some of those tech stocks are going to get hit hard, especially if this tariff or these trade negotiations don't go super well.
It's hard, it's hard to argue with that, and it's almost, if I didn't know any better, it sounds like you're being defensive, and you might have started your own firm just recently. I don't know, but maybe that's the case. All right, man. Love having you on, Luke. Thanks for coming on, brother. Always great content.
You,
Luke Lloyd, the Lloyd.